Welcome back to the channel. Today, we're diving deep into one of the most misunderstood and controversial strategies in the stock market, short selling. If you've ever heard phrases like betting against the market or profiting from a stock's downfall, you've already brushed up against the concept. But what does short selling actually mean? How does it work? And why do some investors swear by it while others consider it risky or even unethical? Let's break it all down. Short selling is a trading strategy that allows investors to profit from a decline in a stock's price. Unlike traditional investing, where you buy a stock hoping it will go up, short selling flips the script. In a short sale, you borrow shares of a stock from a broker and sell them on the open market. Your goal is to buy those shares back later at a lower price, return them to the broker, and pocket the difference. For example, if you short a stock at $100 and it drops to $80, you buy it back at $80, return the borrowed shares, and make a $20 profit per share. Let's walk through the mechanics. First, you place a short order with your broker. The broker locates shares, usually from another client's margin account, and lends them to you. You sell those borrowed shares immediately at the current market price. Now you're short the stock, meaning you owe those shares back. If the stock price drops, you can repurchase the shares at the lower price and return them to the broker. The difference between your sell price and buy price is your profit. However, if the stock price rises, you'll have to buy it back at a higher price, resulting in a loss. There are several reasons why investors short stocks. Some use it to hedge against other positions in their portfolio. For example, if you own a tech ETF but think one company in the index is overvalued, you might short that stock to offset potential losses. Others short stocks purely for speculation, believing a company is in trouble, overhyped, or facing declining fundamentals. Short selling can also be used during market downturns to profit from falling prices. It's a tool that, when used wisely, can add flexibility and depth to an investment strategy. Short selling isn't for the faint of heart. One of the biggest risks is that your potential losses are unlimited. When you buy a stock, the most you can lose is what you paid for it. But when you short a stock, there's no cap on how high the price can go. If you short a stock at $50 and it skyrockets to $200, you're on the hook for that $150 difference per share. This is why short sellers often use stop-loss orders or other risk management tools. Another risk is the short squeeze, a rapid increase in a stock's price that forces short sellers to buy back shares quickly, driving the price even higher. The GameStop saga in 2021 is a textbook example of this phenomenon. Short selling has long been a topic of ethical debate. Critics argue that short sellers profit from failure and can contribute to panic selling or market manipulation. Supporters counter that short selling adds liquidity to the market and helps expose overvalued or fraudulent companies. In fact, some of the biggest corporate scandals, like Enron and Wirecard, were first flagged by short sellers. Regulators monitor short selling closely, and in times of extreme volatility, they may impose restrictions to prevent abuse. In most markets, short selling is regulated. You typically need a margin account, which allows you to borrow shares and requires you to maintain a minimum balance. Brokers also charge interest on the borrowed shares, and not all stocks are available to short, especially low float or thinly traded ones. In the US, the SEC enforces rules like Regulation Show, which governs how brokers locate shares and report short interest. Some countries have banned short selling during financial crises to prevent market destabilization. So, is short selling a smart strategy or a dangerous gamble? The answer depends on your experience, risk tolerance, and market outlook. It's a powerful tool that can generate profits in bear markets, hedge against losses, and even uncover corporate fraud. But it also comes with high risk, complex mechanics, and ethical considerations. If you're thinking about short selling, make sure you understand the rules, use proper risk management, and never bet more than you can afford to lose. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and hit the bell icon for more deep dives into the world of investing. Drop a comment below if you've ever shorted a stock, or if you're thinking about it, and let's talk strategy.